Hello, I'm Don Rich. Welcome to this episode of Rich Insights. Today we're going to take a look at the U.S. GDP number. It was just printed this morning. It's the first print for the Q4 GDP. Gives us some idea of how the real economy is growing. Now, the overhead print of 2.1% was not bad. It's a solid number. We're not growing that's not blockbuster growth, but it's not terrible either. However, when we look at the details are a little more concerning. We're going to break this GDP number down, and you're going to get many more insights than you will anywhere else. So let's jump right into this thing. All right. So again, the headline number's down here, 2.1%. You see it's exactly the same as it was in Q3. All right, and there's four pieces of information that jump out to me. First of all, take a look at net trade. All right, this third column here. So just in the way of some background, I tend to break GDP numbers down in these six segments that are shown here. You can slice and dice the data a lot of different ways, but I find that these six are sufficient to give you some pretty clear insight to what's actually going on in the economy and what's driving the results. So we got net trade, 1.51. So if we were to sum these six numbers up, they would give you the 2.1. So 1.51 of the 2.1, the bulk of the growth this quarter was due to net trade. Now, why is that a problem? And where's it coming from? Here we go. The second chart here. What's going on here is our imports and exports are both declining right now. All right. So we got export growth in the brown line, the import growth, year-over-year growth in the green line. All right. So both are declining. That's not good. All right. Now, why is import growth declining more than export growth right now? You can see historically they tended to track each other pretty well. So what's going on right now is we had a very unusual print. The most recent trade numbers had something that we've never seen before in history. And that was that we actually imported no oil. In fact, we were a slight net exporter of oil. Then that was the first time in history that's ever happened. So that accounts for this big import drop. Now what's going on here is the U.S. oil production, of course, is grown considerably. We produce about 12 million barrels a day right now. But we're consuming 21 to 22 million barrels a day. All right, so we're not self-sufficient. It just happens that at times the refineries have enough inventory on hand that they don't need to be importing new oil to fill the supply, the 21 million barrels needed versus the 12 million barrels that we have. All right. So that's the first piece of information here. This net trade. This is not a good thing because imports and exports are both falling. Imports are just falling faster. All right. That's the first thing to notice. The second thing that jumps out at you is inventories. We had a big drawdown in inventories in Q4. All right, that actually subtracted over 1% to our GDP number, or restated GDP would have been over 3% had inventories been ignored, or if we hadn't had that inventory drawdown. Now, some of what's going on here is of course, we had a buildup, somewhat of a buildup in inventories because people were concerned about the effect of tariffs and so forth, and so we're just working off those inventories right now. All right, that's the second observation. The third observation I wanted to jump to here is consumer spending. Now, let's go back here. In Q2 of last year, notice again the headline numbers are essentially unchanged for the last three quarters here, 2.1, 2.1, and 2. But in Q2 of last year, 150% of the growth was due to the consumer, right? The consumer alone would have printed 3% GDP growth, and everything else subtracted 1%, all right? So the consumer was responsible for 150% of the growth in the U.S. economy in the second quarter. In Q3, the consumer accounted for 100%, right? 2.11 of the 2.1. Everything else netted out to be zero. All right. These are are really unusual numbers, right? The consumer normally accounts for 70 to 80% of the GDP, not over 100%, as we had in those 2 quarters. So the consumer has slowed considerably. That should be expected. Consumer spending cannot be expected to continue at these huge numbers. So that was somewhat expected, but it is also worrisome because the consumer has been so important to driving the GDP results of recent. The last thing I wanted to mention down here is corporate spending. Corporate spending, CapEx spending, has been slow. You can see for the last 3 quarters it's been a drag and continues to be a drag. That should be something that concerns you. So what's the bottom line here? Well, the U.S. economy is slowing, but you're not able to pick it up from the headline GDP number, all right? So at 30,000 feet, things look fine. When you look in the details, there's some worrisome trends that are starting to appear, all right? And we talked about this before. Now's the time to start taking your risk profile down, not get crazy, but we've had some tremendous performance in the equity markets, and we would expect those to start slowing down as the general economy slows. So that's our message for today. Thank you for watching. I hope you enjoyed it. I'm Don Rich, and we'll see you again soon.